call for 5,000, they okay, now he's getting sane. Now he's throwing out some real numbers, and now that number isn't that far away, and it wouldn't have been on most analysts' radar a decade ago.
Maybe one last question here, Gary. Where do you see
the precious metals market just made history. After years of sideways action, both gold and silver have officially closed the week at record highs. Gold above $4,000 and silver above $50. Let's break down what's happening. Rashad Hajiev posted, after all gold and silver close above $4,000 and $50 respectively last week, with a declining general stock market, investors will have nowhere else to go but miners. And he's got a point. When major markets like stocks start falling, investors often look for safety. And right now, mining stocks might be that next big play. As gold and silver prices surge, the profits for miners can explode, which could mean massive returns for those holding quality mining shares. Jad Hariri said, gold 4150 next, same price action. We're seeing momentum carry through the charts. Gold holding above $4,000 shows strong institutional support, and the next technical level around $4,150 could confirm the start of a new long-term bull phase if we break above it convincingly.
Yeah, no, it's unprecedented territory. But Gary, what is your target? Where are we going? We got about a minute and a half left. Where's our target? Where are we going?
All right. Well, obviously, what are my tools right now? I can't compare it historically. So I fall back to formulas that closely represent nature, which is why I'm a big fan of Fibonacci numbers, which is a sequence where you start with 1 and add it to 1, and you get 2, and then 2 plus 1 equals 3. Then you go 5, and all you're doing is summing it up. And then you look at the relationship between the difference between all of those numbers. And so that's where you get the 618 from, the 38.2 and the 23. Those are all fractals of the basic blueprint, I call it, of nature that can be expressed mathematically. And Fibonacci did a really good job of doing it in a way that we could plug it into other things so it wasn't so abstract. And so my targets right now originally were 3,800. Well, we can throw that one out the window. Right now, year-end target is 4,150 to, let's say, and see, I'm already over exaggerating this number, 4,300. But if it hits here, I've got to upgrade that. In other words, my target was 3,800. What am I going to do with that now? That goes into the digital trash can. So
right
right
now,
I
received any hate mail though for it. Did anybody send you hate mail for reaching your target? So
the more aggressive they are, the more my subscriber base loves my analysis. Are you kidding? Yeah. If I call for 5,000, they okay, now he's getting sane. Now he's throwing out some real numbers, and now that number isn't that far away, and it wouldn't have been on most analysts' radar a decade ago.
Maybe one last question here, Gary. Where do you see the downside risk? If gold were to correct tomorrow, where do
Gary Wagner's words here are critical because the gold market has entered uncharted territory. Traditional analysis no longer works, so he turns to something timeless, Fibonacci mathematics, the same pattern found throughout nature. These ratios, 61.8, 38.2, 23.6, reveal how markets naturally expand and correct. Gary's old gold target of $3,800 gone. The market broke through it, and now his new range stands between $4,150 and $4,300 per ounce, with potential to climb even higher. He says it best, his old forecast belongs in the digital trash can because what's happening now is rewriting the rules of precious metal valuation. A decade ago, $5,000 gold seemed impossible. Today, it's realistic. And it's not hype, it's the market's natural progression as global confidence in currencies weakens. Gary's analysis shows that gold isn't just rising, it's following a mathematical path of nature itself, and that could redefine its true value in the years ahead. Investing.com shared Goldman Sachs hikes December 2026 gold price forecast to $4,900 per ounce. When big institutions like Goldman Sachs raise their long-term targets, it signals something deeper. They're pricing in sustained inflation, geopolitical risk, and the ongoing devaluation of fiat currencies. If gold reaches near $5,000 by 2026, silver could easily follow with an explosive move above $60 or even higher. Tim Hack tweeted, "Today's movement in the crypto market could be evidence that a major capital rotation into safety is imminent. The price of gold could increase tenfold when measured in Ethereum. Gold will easily reach $20,000. Some mining stocks will increase 100-fold, some even 1,000-fold." This is a bold prediction, but it reflects a growing narrative. As confidence in traditional and digital risk assets weakens, money tends to rotate into hard assets like gold and silver. While a 10x move sounds extreme, we've seen stranger things during times of monetary resets. The mining sector, historically, has delivered outsized gains in such environments, sometimes even 100x returns during parabolic metal rallies. Peter Schiff added, "Today is another example of why Bitcoin is not digital gold or even digital silver. Gold closed the week up 3% above $4,000 and silver rose 4.4%, closing above $50. Both represent record high weekly closes. In contrast, Bitcoin dropped over 5%, double the decline of the Nasdaq." Peter Schiff has been saying this for years, and this week, the numbers speak for themselves. Gold and silver outperformed not just stocks, but also Bitcoin. This doesn't mean Bitcoin is dead, but it does show that precious metals are regaining dominance as real-world hedges against inflation and systemic risk. So what does all of this mean? We could be at the start of a major rotation into tangible assets, where investors flee paper and digital risk into physical value. The setup is almost identical to past cycles where gold and silver led global capital reallocation. If this continues, 2025 might be remembered as the year precious metals reawakened. Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Markets are volatile, and past performance does not guarantee future results.